Right, another good update today. 4% move to the upside in a lot of these major equity indexes. So now the question is this it? Right? Is the worst behind us, or is there more downside? And how quickly will do we have downside left this week? Do we have how much more downside left do we have? What should the market look like when we are ready to get going again to the upside? So I'm going to break that down today. Break down this move that we've had in such a short amount of time over the last couple of days. How do we take advantage of this move with our trade idea of the day? And then we're also going to take a look at why any red flags that we might have had during this bullish run and why it might not be as bullish as you think it is. So let's go ahead and get started. Today is Wednesday, March the 4th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off looking at the market forecast indicator on the S&P 500. Nice, good rally to finish the day today. Big pop here at the end. They got us up to the 50% retracement level. Got us up to basically close to yesterday's highs on the SPX, 3130. We're still in that retracement zone between this 38 and 62% level. So we're still kind of popping, but we're not through, right? We have to kind of get through this before we really get bullish, right? In terms of like V bottom or whenever. If we're going to really take off to the upside, we have to clear this 78% level, right about 3280. This old 23% level, 3264. And moving average happens to be up there. Again, to get a dark green line, you have to be above a rising moving average. So we're still pretty decently far below, with lots of resistance above where we're at right now. So we're not out of the woods at all, needless to say, on this bounce. In fact, it's a good opportunity potentially just to take advantage of this bounce with a move to the with an expected move back down. It's a good rally off of a low point 4 days ago of 28.55, and we're closing up at 31.30. That's what. 45 points, 245 plus another 30, so 275 points to get up to that level. It's a pretty decent run. That's almost a 10% move back up here, just like that. In fact, if you look at the zigzag, we can see what that move has been. Look at the ups and downs. But if I were to change this to say like a 5%, if I were to change this to like a 5% zigzag here, 5%. Then you can see a 12.5% drop, and then this would be off of the here. Let's do the high and the low. Let's do the lows. No, we can't do the highs and lows on it, because if I do the lows, it will get me down to 6.25% off of that low. So from a 6 all the way up to 30.30. I mean, we're talking like almost a 10% move. That's the type of move that we've had. So pretty decent move. Needless to say, pretty decent move to the upside that we have here. In fact, actually, we can do it. No, we can't, unfortunately. So with that being said, let's now go back to the market forecast. The near-term line has not gotten into the upper reversal zone. Despite that, this shows how bearish that we were, and still could actually set up a bearish near-term high point, a high between 50 and 80 that is lower. See, here's the last near-term high point, way up here. And we had that big divergence here, and there's the last near-term high, and so obviously we'd be easily setting up a lower near-term high point with a peak between 20 and 50. You see, we're not getting any momentum lines spiking up to the upside. It's really hard to do when you're really bearish like this. So don't expect, that this intermediate. I mean, we could very well get dark green shading well before we ever get a green line. But even then, we're at light green, and if you look at the Russell 2000, you can see we're not nearly as bullish. It's still dark pink because we're still in the lower reversal zone. We are a little bit up here on the NASDAQ because that's kind of what the S&P is right now. It's kind of turning into the NASDAQ 100. But look at the Dow Jones, and you can see this. I mean, we're well below 30-day moving averages. And near-term lines, not in the reversal zones on any of these. Falling market sentiment lines. In fact, the Russell 2000's market sentiment is almost back below 50. And that's what we're expecting. And in fact, depending upon how we close this week, we could very well get a death cross out of this if we finish closing below the 200. The 200-day moving average is about down here now. So we'd have to close back below the 200-day moving average by the end of the week. And I actually wouldn't be surprised. And I kind of almost expect that we will close back below the 200-day moving average by the end of the week. That this little rally we've had is very, very temporary. Just Fibonacci retracement, and especially considering that we're hitting up against some resistance there. And not just there, but you look at the Bollinger Bands, and you can see this big volume node that we're at here. I mean, it's relatively big. It's not as big as this one here, where we hit support, but it's one of the bigger volume nodes we have on that we have gone through, and will act as a resistance here to the upside. And then you'd have the next layer of resistance here, basically at the top of the Fibonacci retracement zone at about 320 on SPY. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below our video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked the video. And number two, you want us to do it again tomorrow. So a quick way to give us feedback. You can do that right now while you're watching. Of course, if you don't like our videos, you don't have to click on anything down there. And then comment down there too. What did you get out of our videos today? I always love to hear that. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog, as I know most of you watch us here, check out our Market Outlook Live videos. If you click on this image, that takes you to our Market Outlook Live page. You can also get there by mousing over Market Outlook and clicking on Market Outlook Live Trade Review. We review all the old trades that we've done in my Market Outlook videos, the active trades that we've done. We manage those trades all the way up to the close. So we also talk about position sizing. So make sure that you check out those videos. We also put on today's trade idea already. So before the market closed, the one that you're about to hear at the end of this video, we've already put it on. And so those who are watching the live video knows what the trade ideas are early. You kind of get a sneak peek, so to speak, and are able to put that trade on before the market closes. We also invite you to engage with us here on social media. Click this little heart. We got up to 100 likes, so that's awesome. And hit that like button. You can like today's Market Outlook tweet. Same thing, hit that thumbs up on Facebook. You can like today's Market Outlook Facebook post. Again, that helps us because the more likes and retweets, the more Twitter and Facebook will push our content to everybody who follows us, because they don't do that. But also benefits you because you'll make sure that you get all of our content when you're not on. When you come back to the platform, they'll make sure that you see all the stuff that we put out in between. So they will push content to you that you engage with the most. So we try to make it very easy for you here. All right, back to the charts, and let's go back to the Heikin-Ashi candle, and you can see, let's see the 10-year chart. We're still bearish here, and if you look at where we're going to open up, and we've still got 2 days left in this week, so we're not done yet. But if you look at where the Heikin-Ashi, the open for next week's candle is going to be the midpoint of the close and the open here. So divide that by 2. So 31.27. We're trading at 31.30. So we're already going to be above next week's open. That's actually another reason why I kind of think that we're going to finish closer to the low this week than we are the high of the week. So keep that in mind, that that would make next week's candle a transition candle just like that. And I don't think we're that quick. Now we kind of had it over here after a couple weeks. We had a quick transition candle, and then we went up a little bit. And if anything, we could get something like that. The difference is we didn't come down on the difference between then and now is we didn't close the bad week so far below the 200-day moving average. When we did, it was hard for us to come back up. So we're above it now today, but with 2 more days left, if we finish back below it, and if we do finish near the lows or closer to the lows, then there's a good chance that even if we just finish kind of where that 38% level is at 30.60, there's a good chance that we end up with the death cross, right? Which in this case, all it would mean is it will take a few weeks to hammer out this low and base it, and build it out, and you'll get the death cross there before things turn back up and really get going again. Let's take a look at the 3 green arrow chart, and whoops, not that one. That's the market forecast chart. The 3 green arrows. You can see we got a green arrow. Stochastics is usually the first one to come back when you're green. The moving average will be the last one. The MACD is well on its way, and the MACD typically will get a green arrow while you're still bearish. If you notice, the MACD, the low point is so low, it's really hard for us to get going back to the upside and get this back above zero. If you go back again to the previous times that we've had strong bearish moves, you can see we did get the MACD turned green, but we didn't get up above zero, barely, before we rolled over. And then over here, kind of the same thing. So I kind of expect that, we're even further down below. I don't think that we'll get all the way up. See, this is different because this was the end of a market sentiment pullback instead of what appears to be the beginning of one. So watch as we'll get closer towards zero on the MACD itself with a green histogram, but don't expect that we'll get, like the stochastics again into the reversal zone. It didn't do it either time here, and I wouldn't expect it would do it here either. Eventually, as we work this out, you notice we are barely, this whole rally that we had, from, again, 285 all the way up to a high of 313. As big as that rally has been off of that low, it's still just barely above the 8-day moving average. So keep that in mind. If we do pull back towards 300 by the end of the day or the end of the week, we'll be still pretty sharply below the 8-day moving average. That's still pretty bearish. So we are hardly out of the woods at all. And you look at the range and you can see we still had a pretty decently sized range today, and that doesn't include the gap. In fact, if we take a look at the other reason why I think there's a good chance that we kind of stop here is because you notice we kind of got up to the 312 area, which is the 50% of this range that we had to the downside. And there's a little bit of a volume node here as well. There's a good chance we roll back over. And again, 300, there's some volume down below us, and I think we still have to build out the volume here in this area before we can really break out, especially with, still for the 4 weeks, the value area is still above us. Most of this 4 weeks volume is still above us here, which is what the value area, the purple shading shows us where 70% of the volume over this time period has been. So 70% of the volume in the last 4 weeks has still been above 303. So we don't have very much volume down here. It's just quick down and quick back up, and a lot of it was a gap. So and you notice we gapped here at the open. So I fully expect that we'll fill in that gap sooner rather than later. Might be tomorrow, might be Friday, but by the end of the week, I wouldn't be surprised if we don't fill in that gap and fill in some of that gap too with volume to really build this out and bring the shaded area down. That's going to have to happen before we can really get going, because that's going to act as a big pressure, like a high pressure weather system, right? Weighing down. It's hard to get some rain, right, and some moisture when you got that big high pressure holding you back, holding you down. So that's kind of what's going on here. You got a big high pressure that eventually you want to get below us so that we can get above where there's low pressure, and that's really you can get going to the upside on that move. The high is still kind of in the middle, so eventually, if you're bullish, remember the high has got to be over here and the low has got to be over there. So we're still kind of in bearish territory where the low right now is still to the right of the high. And once that flips, that'll be another sign that we're back to being more bullish again. But even that can be, you can still get, a 4 week high on the day, like we saw on market sentiment pullbacks, and still not be able to really get going. So don't get too caught up in the bullish bounces here, because the idea, and I shared this in my class today. Here's the the daily 1% moves. When you get these big pullbacks like we've these market sentiment pullbacks, when they start off, like we had over here, you get big down moves. They're almost always followed by big up moves, and big down moves are always followed by big up moves. And you don't really get going to the upside until you stop getting big moves. So you stop getting the big down moves. And you still kind of get going, and you see over here, you had the big down moves followed by big up moves, down moves and up moves, and down moves and lots of down moves, and then followed by big up moves, and then you stop getting the big down moves, and you stop getting the big up moves, and we just grind our way higher. Well, here we are, big down moves, big up moves, big down move yesterday, big up move today, and so until we stop getting those big down moves is when things settle down, and I don't think that we're to that point yet where we're done getting big down moves. This big up move was basically just a response to what we saw. We kind of need to stop getting such extreme moves and start getting more kind of 1% or less up moves to the upside and start bringing some of these levels down. You see the VIX. The VIX still is pretty elevated, as bullish as we were today. It's still pretty elevated at 30, and the VIX to VXV is still up there right around that 115% mark. If that's where we close to, if this was our worst day of the pullback and this is where we close, this close would be telling me to expect a market sentiment pullback. So we're still not, we're still not getting really good levels here that suggest the worst is behind us. There's still opportunities for not the worst to be ahead of us, but to still fill in some of that gap and retest low points again on the S&P. Looking at the range today, the range, like I mentioned, was 9.77 points, but you have to keep in mind the gap here. We closed yesterday at 300.24, the low today 303.33, so there's still 3 points of range that occurred overnight that you actually have to add to that. So the reality is that's still a really high almost 11 point range. Whoops, not that one, it's this one. An almost 11 point range is still well above that's almost 4 times 4% of the current price. The ATR, which it's going to keep moving the ATR up, and it's going to keep moving the ATR relative to price ratio up. That 2.5% mark is the mark that usually tend to get death crosses because that's so it gets so high. But again, the nice thing is, and that's kind of what I said today, that's all that means. It doesn't mean we're going into recession. It doesn't mean that we're in bear market. I don't believe any of that. And of course, anything can happen. I just don't believe any of that yet. We have to break the 200-day, retest the 200-day, and then fail at the 200-day before I'm really getting worried about bear markets or recessions. So I don't expect that to happen yet, especially with yields as low as they are. But all that does mean, though, is it will take a couple of months for this low point to work itself out. And then when it does, we'll get a really good, because these levels, as you see, if I go back in time here, when these lines get this high, it takes a long time for them to come down, right? You can't really see it as well, but you can see when they get, in the last 10 years, we haven't been this high in the ATR. It's been a long time because we don't have that 2009 level anymore. So the ATR is this high. But if you look at the ATR price ratio, the relative ratio, we have been this high. Now remember, we're not done going up. This is a 14-day ATR, so it's going to take time. So we could very well get closer to 3, and we did get close to 3 over here in 2011. And I think we're very similar to that here. It did set the low point. This took a while, but once it got going, then we had a good run on equities. Because of how low yields were at that time and how much this had to go down and how much the volume had to come down from really high levels and how much, so here we are again, and we're not close to that level of volume because we're a lot higher price. That's what keeps these volume levels down. But we are probably going to get closer to 3% by the time all is said and done on this. And that just means it will take a while, a couple of months probably to work out. But when it does, we'll get especially with yield so low, we'll get a really good run on risk appetite out of this. All right, before we dive a little bit more into these other asset classes, I'll just summarize our technical outlook here. It was a nice bounce. It's probably going to be a very short-term bounce and most likely lead to a pullback over the next couple of days by the end of this week, back below the 200-day moving average. And it will lead to some big downside moves, and that will lead to big upside bounces, and that's probably how it's going to be for the next month or two. Probably not to the 3 to 4% extremes, but closer to the 1 to 2% levels. As eventually we kind of peak out here on the ATRs. You don't see the chart, but we peak out and volatility subsides, and we start slowly working our way down. That's okay, though. We can be able to take it. As you'll see with our trade idea today, we'll take advantage of these bounces. We took advantage of the bounces in our class with the futures trade that we made last week, and it's really benefited us over the last week or so. So that's okay. It's okay. We can still trade this volatility. There's lots of things we can do, and it's really okay because coming out of that volatility, we're going to have some trend trade opportunities out the wazoo for some really good opportunities to the upside. So that's our outlook here. So again, kind of a refresher, just don't get worked up over the big drops. Don't get worked up over the big bounces either. Especially don't get suckered into them thinking that all the selling is done now. That being said, what do you think? Do you agree with that technical assessment? Do you disagree? Click that link. It opens up a poll, and then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests that maybe you're more bullish than I am, or that look out below, that this is temporary and we're not just going to retest lows, but we're going to really drop to the downside. Whatever you see that suggests either one of those two things, share with us down below in the comment section. All right, if you look at the chart here, and you can see that this is the 4-week chart for the different major asset classes and what's driving this price action. You can see we are up to new highs on the S&P 500. You can see we dropped a little bit in bonds today. We didn't drop very much in gold. The safety trade's still very overbought. In fact, the safety trade still, like, this is a 1-year chart. The S&P is up over 10% on a 1-year basis, and gold and bonds are up 25 to 30%. Crude oil is down 15%. So this is still, as bullish as we had been, we're still, like, the safety trade's even that much more bullish, right? If I go out a couple of years, you can see real estate also up there, 30%. This is this is a 2-year return on the S&P of 16%. Small cap stocks are actually down over 2 years. Emerging market stocks are down 13% over 2 years. This is from March 2018. Remember, they really peaked. They peaked January, and I've shown you this chart before. But in January, when risk appetite peaked, that January 26th of 2018, it was really the next day. You can see we start off with a gap up there, so it's actually the next day there where we started down. From that period, look, S&P is up 10%. The small cap stocks, and this is more than 2 years, small cap stocks are down. A 2-year return, that's pretty hard to have a 2-year return down in the negative. But this shows really how bearish we've been, and the fact that gold is up 20% over 2 years, and long-term bonds are up 25% over a 2-year period. And then you have the dollar as bullish as it's been over a 2-year period. Look how strong the dollar's been. It's put a lot of pressure on equities and commodities, for that matter. This is hardly the chart that would precede a recession. In fact, this is more of a chart that looks like we've been in a recession. And the fact that the S&P has been up kind of hides and masks the fact that we've been in an asset, like the asset class are showing that we've been in a little bit of a slowdown in terms of risk appetite. So maybe not an official technical recession, but it's kind of hard to look at this 10-year note and think, this 10-year note yield, and think that we haven't been. That's a chart that looks like we've been in a recession. If you just look at that chart alone by itself, of course, the comparison to the S&P 500 would suggest otherwise, right? The comparison to the S&P 500 thinks, well, since 2018, everything's been fine. Well, especially since October. Well, once we peaked here on bonds, yields, stocks fell and eventually rallied, and it's been up to new highs, and we're well above those October highs, but we are not above those October highs on bonds, and we are way, way down. And so that actually kind of shows that maybe we have been in a recession that we don't realize. But the nice thing is, again, the safety trade is extremely. You look at bonds, and you see how extremely overbought we are. In fact, if you look at the linear regression chart here and look at the 20-year linear regression, and this is actually a 1 year. Let's go to the 20-year chart. If you look at the 20-year chart for linear regression, long-term bonds are 2 standard deviations away from their 20-year linear regression line. That's extreme. Gold is pretty strong too. It's not as strong on the 20-year chart as it is on like this 10-year chart. We're above the 1 standard deviation. So that's a pretty strong, not as extreme, but still pretty overbought. And then you look at the dollar, and the dollar hasn't been nearly as extreme. If you go out even longer, you can see we are more overbought than we are. So there's opportunity to pull back down. You would think, well, why would the dollar pull down? And that's when we're in a non-inflationary environment like we've been in, with yields falling as much as we have, and the inflation expectations falling as much as they have, pretty much since the beginning of 2013 was the last time inflation expectations really peaked. Well, if you look at the beginning of 2013, that's right here. Since then, the dollar's been bullish, right? That's that's with falling inflation expectations. Well, now, if you expect inflation expectations to be bottoming out and bouncing again, you would expect the dollar to come back down too as a result. And that's actually going to be really, they have a really strongly bullish dollar with long-term potential to drop and to have commodity prices as low as they are. You look at crude oil prices here, and you can see they're on the lower end. To see them, and that's on the 10 or 20 year. If you look at the 10 year, they were close to being, last month they were down to 2 standard deviations below. So we're really oversold on commodities. We're really overbought on the safety trade. Is this the type of market that looks like, and again, there's that October 2018 peak. This looks more like we have been in a recession. We just don't think we have been because the S&P has held up, and the S&P has held up because it's been a safety trade relative to other equity opportunities elsewhere out there. And for that matter, bonds and yields have been so extremely low everywhere, but especially outside of the U.S. So it's been an opportunity for the S&P to stay lifted up as an alternative trade. But it's kind of masked the fact that there's been a big old move out of risk appetite in other asset classes into safety. And once that safety trade unwinds, once this shakeup unwinds itself, there's potential for a really good move to the upside in risk appetite as a whole, including equities and especially small cap stocks, international stocks, emerging markets, and things like that. Let's take a look now at the sectors and how they've performed over the last 4 weeks. So we'll come out here. This would be 1, 2, 3, 4. Go out to the 4-week chart on these, and you can see again how everything has fallen. And look at energy still struggling, financial still struggling to really get going, and look at the safety trade. So since this, in the last couple of days here, let's go to the beginning of the week. So far this week, look at what's been rallying the most: technology, consumer discretionary, communication services, industrials, energy. Like, these are the sectors that should be outpacing the market during a rally, not utilities, staples, and real estate, right? This is during a rally that those are out. They're not up there because they held their value better during a drop and then now everything's bouncing and they're just up there because they held their value better. No, this is from the low, right? From the open on Monday, that's the safety trade that's been leading us higher. And healthcare for that matter too, especially today with the Super Tuesday results and how that might impact the healthcare sector. So again, you're going to really think that we're taking off here on a V bottom low because the safety trade's so overbought right now. Almost double the return that you're getting in the broad market as a whole, and they are doubling up the returns on these other cyclical sectors. That's hardly the case. In fact, this is a big red flag in terms of how bullish we are right now, and is very susceptible to a downside move here in the short, as quickly as the next couple of days, because that's not, you want the cyclical areas to lead us up on a move. This is not a risk appetite move in the least bit. So to take advantage of this rally, which is a little tenuous at best, I wanted to take a look at a stock that, that's had its own little rally and it's had a really good move to the upside, and has given us a bearish pattern on this chart, on its market forecast chart. You can see, especially really blowing through here, and I expect we'll have a little bit of a fake out breakout move, but you see how we have a yellow line and dark and light green shading after having dark pink and a red line. That's a bearish pattern. And again, considering how much it's gone up, I think it's really fluffy here. Again, with all the safety trade as bullish as they've been, I think there's an opportunity to really take advantage of this rally up to the upside. If you take a look at, like it's Ichimoku cloud, you can see we're up through the top of the cloud. If you take a look at the Bollinger Bands for EA, you can see that we're up through that volume node to the path of least resistance. There's still a gap of volume down below us. So with all that being said, like, do we expect EA to be breaking out to the upside? Obviously, it would have an impact on that would be whether the market itself is expected to be breaking out to the upside. And my thoughts on that, and especially if you look at the directional indexes, where is it? Right here. If you look at the directional indexes, the positive looks great. but the negative is not down. It's a little bit below 25. It has not broken below 20 yet. See, that's when you're bullish, is when it breaks below 20, and it hasn't. So it's fine that the positives bounced up here, but I think that's a little bit of it's going to be a fake, end up being a fake out, with that bearish line. I think the blue line's going to get below 20, and we're going to be bearish here for a while and getting that ADX back up above 20. And I think we'll have an opportunity to sell this. I think this is a glaring example of the type of trades right now we can take advantage of the bounce that we've had to play a potential downside move back to its recent lows on this stock or any other stock. And this is just an example of being able to do that. So what we did on EA is we bought a put 44 days out, 251. We bought the 105 put out of the money, below 40 in the delta, and we sold the 100 put to help cover the cost. So that gives us a cost here of what, $1 or 98 cents. Ended up being 98 cents. You can see we're up a little bit right now. Like I said, we put this on before the market closed. We position size for a small risk. So if it does break out to the upside, okay, I get nicked a little bit, $250 loss, 500 at the worst, right? But if it does break back down and retest those lows from last Friday, then I've got the potential of $2,000 reward for my $250 of risk. And I'm more than willing to take that and then some, right? And it gives my portfolio, you can see here in our market outlook trades, it gives our portfolio some negative delta. These are all the other trades that we've been doing since. It gives me some negative delta to offset some of the positive delta that we have in our inventory as well as our swing trades. So gradually neutralizing my delta and adding some more negatives here to take advantage of these big bounces that we have, big bounces like this. As we roll back over, we want to be more negative delta. As we get back down to the bottom, we want to neutralize that delta on the potential big bounces to the upside. And just know, as I said before, when you get the big downward moves, they tend to be followed by big upward moves. So we'll look for those moves back down to support and then take advantage of the big up moves like we are today, and take advantage of the big down moves like we did last Thursday when we did that big futures trade, to be able to take advantage of the big move to the downside and the big move to the upside since then. All right, well, that does this for today. You've heard from me now. Now I want to hear from you. Use that link right there in the top right corner of your screen. It opens up, takes you to our Market Outlook forums on our website, on our community. You can be able to interact with other market scholars and just keep this conversation going. Open up any new threads with any questions or comments you have about today's video or anything else pertaining, and then reply to other people's threads. And let's, like I said, keep the conversation going here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon on our video, like and comment on it as well. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group, as well as our website at marketscholars.com, our community on our website. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.